Good morning. Why suburban industrial is outperforming CBD right now? And the shift is already happening, capital is moving, and tenants are deciding. And right now, suburban industrial real estate is outperforming central business district or CBD assets across the country, and particularly in Houston's westward growth corridors like Katy, Fulshire, Brookshire, and along I 10 and the Grand Parkway intersect. And this isn't temporary trend, it's a structural trend. So the core shift there is function over location. And for decades, CBD assets commanded premium pricing because of proximity, and that meant productivity. Whereas after COVID, that's not necessarily any longer is that true. And today's economy will prioritize logistics efficiency, labor accessibility, cost control, scalability, and industrial properties, especially in suburban corridors, check every box on that list. So let's talk about logistics wins, and proximities to highways is greater than downtown access. So suburban industrial sits where distribution actually happens, near I 10, near Grand Parkway 99, and the West Park Tollway, where it's closer to rooftops and the end consumers. And it's possible to achieve faster last mile delivery as compared to CBD locations where you have congestion, limited truck access, but also higher operating friction. So let's talk about tenants that choose speed and efficiency over prestige. And basically, lower costs equals higher margins. And suburban industrial will deliver the lower land costs, the lower property taxes relative to CBD and high rise assets, but also lower operating expenses and simpler construction. So think tilt wall constructions or flex industrial warehouse construction. And for tenants, that lower is it turns into lower occupancy cost, but also more usable square footage. And for investors, high yield potential and better risk adjusted returns. So let's talk about e-commerce and supply chain reshaping demand. And e-commerce and inventory decentralization have changed everything. And companies now need distribution nodes that are a little closer to suburban populations, but flexible warehouse space, and also outdoor storage. So think iOS properties and also last mile fulfillment centers. And that demand doesn't go downtown, it goes suburban. Four is scalability, how industrial can expand, whereas in a CBD it can't. And suburban markets will offer larger land tracts, but offer the opportunity for a built to suit opportunity, but also give you expansion capability. And CBD assets are constrained by zoning for one, but also density. And there's also higher redevelopment cost in a CBD location. And the point is, industrial grows with the tenant, whereas CBD is limiting them in that market. So, five is lease structures that favor industrial investors. And industrial leases are typically in the triple net variety. So, and then leases, longer terms, so 5 to 10 plus years, with annual escalations. And what this does for investors, it creates predictable cash flow and lower landlord responsibility, but also stronger valuation stability. So, a central business CBD office would result in higher tenant improvement costs, but also shorter leases and more volatility. So, let's talk about office weakness and how that's accelerating the shift. And CBD office markets are still dealing with remote work trends that are bringing down the overall use of their office. And that results in elevated vacancy for the buildings. And tenants are downsizing, and lease renegotiations are critical right now. Whereas, meanwhile, industrial vacancy remains tight in the right quarters. And capital is going to follow stability, and stability is in industrial right now. So let's look at Houston as a case study and its westward expansion. In Houston, this trend is obvious now that the Katy and Fulshire area is equal growth because of population and rooftop counts increasing. And industrial demand follows housing expansion. And developers targeting I-10 West and 99 corridors are looking at some of these key drivers, but Port Houston's expansion, manufacturing's reshoring, and also the energy corridor spillover, but also AI and logistics infrastructure. They're all draws. And suburban industrial is positioned directly in the path of that growth. So let's look at some investor takeaways. If you're allocating capital today, suburban industrial is going to offer some unique attributes, and that's a little stronger tenant demand, but also predictable income through triple net leases with lower volatility. That's a scalable investment that aligns with macroeconomic trends right now as well. Whereas CBD assets will face a little higher vacancy risk, a little more capital expenditure pressure, and may have some tenant uncertainty and structural demand shifts that you have to account for. So the final thought for the day is this isn't about abandoning central business district. It's about recognizing where momentum is right now. And industrial isn't just outperforming, it's redefining the market. And the smart capital right now, it's already positioned ahead of the curve. So take action today. And if you're looking to invest in industrial or reposition your portfolio in Houston's growth corridors, let's talk strategy. And we can identify some high demand submarkets before the next wave hits. And that, my friends, is it for the day. Please visit my website, HoustonRealEstateBrokerage.com, to figure out how to get a hold of me. Love to talk to you more. But yeah, reach on out. Talk soon.